Good morning, guys. Good to see you both.
Good morning.
Good morning.
David, let's talk a bit about the energy shock, the commodity shock, the different ways it's affecting Europe versus U.S., and then what recession risk means for both continents.
Yeah, so I'm nervous in the United States. I'm nervous about the inflation consequences because we are going to see higher inflation from this. It was already high. But I think the good news is I think we can avoid recession. If you look at the bounce back in activity as COVID fades, and then look at the JOLTS report today. I mean, it is a record, the gap between the number of job openings and unemployed people. It's 5 million extra jobs relative to the number of unemployed people. That's such an excess demand for labor that I think the labor market will stay tight, and that'll keep us out of recession. But Europe does have a more challenging situation, both in terms of inflation and in terms of recession. I think really key there is, can European policymakers issue more bonds, do something in terms of increasing energy spending, defense spending, but also help out middle income and lower income households in Europe so they can keep spending despite the hit they're taking from these higher energy prices.
Right. Omar, I do wonder what your view of Europe is right now and how you think that's going to affect asset allocation, at least vis-a-vis Europe versus U.S. right now.
Well, when it comes to Europe, the word that comes to mind is more stagflation more than a recession. I think, given the situation on energy prices, given their dependency on energy, and clearly the conflict in Russia, the possibility that already at a slowdown in growth with, higher inflation is something that we haven't seen since the 1970s. And Europe is probably going to get into that point very soon. When it comes down to asset allocation in terms of this, in periods of high volatility, normally what you see is, the defense areas such as the dollar or gold or even the defense sector is doing very well. And therefore, it's going to take some time for, that imbalance to come across back again with periods of high volatility, which means, you still have the U.S. leading the majority of the developed markets world and emerging markets as well. And Europe still has the potential in the future. But, given this current setup, it's going to take a while for Europe and the rest of the world to catch up.
Yeah, David, when it comes to Europe, how bad is it going to get over there, particularly given, obviously, their reliance on so many energy products that are going up dramatically in price?
Well, even within Europe, it's pretty regional. I mean, the further west you get, the smaller the impact. But it also really depends. I mean, I'm encouraged that the European Central Bank is thinking about issuing special bonds to fund additional spending here. And I think the European Stabilization Fund, which they set up to deal with the coronavirus, that really was a watershed moment. Because if, Western Europe, I don't know if we appreciate in the United States here just how deeply this all impacts psychologically people in Western Europe. They are really united and in trying to help the Ukrainian people and trying to deal with this. So I think this may allow the Europeans to act much more in concert than they normally do, pass some additional fiscal support for low-income households and weather this. So it's really a matter of, can policy move fast enough in Europe? And I'm somewhat hopeful that it can.
Yeah, certainly the polling data and the obvious policy shifts in Europe have just been staggering. Finally, Omar, looking forward to the Fed, I do wonder whether or not you think they're either qualitatively or quantitatively their message next week is any different than it would have been 2 weeks ago.
Well, definitely different than it was 2 weeks ago. And if you actually just think about it, 2 weeks ago, the market had priced, and I would probably say Fed officials were very clear on a 50 basis points rate increase in the coming meeting. However, the market has retracted, and so is the Fed, of actually starting with 25 basis points. That's such in a way of easing monetary conditions without necessarily having to do anything. And that in itself reflects a little bit of the uncertainty we see in the market. The Fed and other central banks are in a very difficult position at the moment where they have a mandate to try to look for inflation solutions. But at the same time, these levels of volatility, these levels of uncertainty, it's something that just derails potentially the economic growth and the deceleration we have already been looking into.
Omar, David, thank you guys. A lot to absorb in the coming days. And of course, CPI tomorrow. We'll talk to you soon.
Thank you.
Thank you.
Well, it's going to be a huge hour. We are live from the McAleese Conference. Do not miss U.S. Army Secretary Christine Wormuth. She's going to be joining me next, right after this break. You don't want to miss it.